Volatility and options trading. This is going to be a little more of an introductory video, and I want to walk you through what volatility is, how volatility impacts options, some kinds of volatility. There's actually quite a few. We're going to go through some of the primary variations of it. And then I'm going to give you some tips and tricks on how you can use volatility in your trading. Even if you're not an options trader or a futures trader, you can still use volatility to help gain context about the market around you. And I'll show you some cool bar chart tools to help you leverage this concept. So what's up, everybody? Eric here from ES Invest YouTube channel, the Outlier Trading People. And let's get straight in. And as you know, we got to start with a disclaimer. So I am not a part of bar chart. Nothing I say should be taken as financial advice. This is for education, looking to share some knowledge. So let's get straight into it. What is volatility? Well, it's pretty simple if you think of it at a base level. It's a variation of something. So volatility can apply to tons of things. We use it in trading to talk about the variation of price typically. But think if you go to a place where you're visiting and the temperature moves a lot. That means that the temperature there is highly volatile. And if you live in Southern California like I do, the temperature doesn't move quite that much. So this would be less volatile. It just helps us understand how much something is move or is expected to move. So let's look at a visual representation of this. Here we have a monthly candle chart of SPX going back 10 years, and you can probably spot the volatility. Just what I've already told you. It's about how much something moves. So if you can already see it, throw in the comments below where you notice it, and I will show you right now two very different periods. So I'm looking at 5-month periods, and I'm comparing the high to low move. So way back here, if you take a look at this 5-month period, the high to low move was 7%. Here, if you take a look at the 5-month period, the high-low move is 48%. So which is volatile, which is not? So you notice even the same product can have different kinds of volatility. You'll also typically find some products tend to be more volatile than others. Think small biotech companies that are getting phase trial releases. They tend to be really volatile because their entire business is predicated on this one thing getting approved. Whereas if you look at something like Microsoft, it's kind of big, doesn't move a whole lot. That would be considered less volatile. So now let's talk about options a little more specifically and how volatility impacts options. So let's start with this. When we think about option pricing models, there are a slew of different inputs we include. Things like whether it's a call or a put, how long we have until expiration, what the strike price is, what the underlying is currently trading at, if there's a dividend, what the current risk-free rate is, and then there's volatility. As you look at all of these different inputs into a prospective pricing model like Black-Scholes-Merton, what do you notice? Well, we know upfront if it's a call or a put, we know when it expires, we know the strike price, underlying price, the dividend, and the risk-free rate. We know all of this. What is the one thing that we don't actually know? It's volatility. So the tricky part when it comes to trading options is for the people that are making markets, think market makers, they have to figure out, they have to estimate what volatility is going to be over a specific period of time. That's very difficult to do accurately, but they have really advanced systems in order to be able to do that. So let's think about how this feeds into pricing. You know all of these inputs. So now let's think about what happens to the premium or the price of an option if things are more or less volatile. What do you think? If something is more volatile, do you think those options would be priced more richly or more cheaply? And if you know, throw it in the comments below and I'll give you the answer right now. So we can see that in the more volatile periods or the less volatile periods, there's a pretty big difference between how these are priced. When markets are more volatile, premium across everything expands. So it doesn't matter if you bought or sold a call or a put, volatility is going to go up for everything. And volatility is going to contract for everything if price is going to contract for everything if volatility contracts. So the impact that volatility has on options is essentially it's the lifeblood of options, because it's the only thing that we don't actually know when we're pricing them. And if you're trading options, if you're buying an option, you typically want something to move a lot. That's volatile. And if you're selling options, you typically want to collect more of a credit up front, which requires volatility. If things don't move much at all, if you buy options, you can't make money. And if you sell options, you're making very little money for the risk you're taking on. So whether you're buying or selling, realistically, we all want to see some level of volatility. Otherwise, there's really nothing for us to trade. So let's review quickly some types of volatility. There's more than this. However, I think these are probably simpler to start with. So we have forecast, implied, and historic. And if you know what these are ahead of time, again, let us know in the comments and we'll see how many people can get the right answers here, and then we'll rack them all up. But as I'm looking at a forecast, this is where somebody is creating what they think volatility should be. So this is if you have an options pricing model, if you're doing Garsh modeling with jump diffusion to capture different movements in volatility to figure out what you think volatility should be priced for a specific asset. So a great example of this is a market maker. They need to forecast volatility in order to figure out what to value the option at in order to offer the market. This is forward looking. Now, options traders, we most frequently use implied volatility. And this is where, out of that equation that I showed you before, the list of variables in the equation, we know all of them, we know what all those values are. So you can derive what the forecast volatility is for an option that's implied. We're implying what the volatility is from the price. So essentially, somebody's going to forecast. You can try to forecast. It's very difficult to do it on the retail side. The vast majority of the time, we are going to imply what the current volatility is from whatever's baked into the current pricing. That's exactly how these two are related to one another. And then historic is pretty simple. This just looks at realized volatility. So how volatile was something over a set duration? And again, if we use that original example that I showed you of that chart, you'll kind of get a sense that if we want to see something that's more volatile, that's going to have these really big movements, and this applies across time frames. These are just monthly candles, but you can observe this same kind of behavior on shorter term candles. And then this is where we're seeing something that's realized or historic volatility that's lower. Now, one quick admin note, realized volatility has a couple different forms. You can actually have future realized volatility. We don't have to get into the detail on that. Just know that historic volatility is always backwards looking. Realized volatility, often we refer to it in terms of backwards looking, but it can actually also be a future projection. But again, we don't have to get into the weeds on that. Historic, good enough. That is pretty well understood. Okay, so now let's talk about how we can use volatility in trading. Well, volatility is fascinating because you can trade it as a standalone asset class. It has its own sets of behaviors. One of the interesting things about volatility is it's actually quite predictable. If we have things that are very, very volatile, we know sooner or later volatility is going to contract. And if we have something that's really not volatile, we expect sooner or later that volatility will expand as markets begin to move. Volatility also clusters, and I can show you exactly what that means. If we come over here to bar chart, we grab the VIX. Notice how price kind of hangs around itself wherever it is, and then it goes through this transition phase, and then it kind of hangs around again in whatever that new level is. Clustering is just the propensity for volatility to hang around at set levels for extended durations or sometimes shorter durations. It doesn't have to be long term, but definitely multiple days. And then we tend to see a transition of some sort. So here you can see that volatility was clustering kind of low, and then we saw a pretty rapid expansion. Notice how quickly it moves during this phase, and then it clustered again. So it's an important trait of volatility. And again, we can go further into detail on how to actually trade that, but I think it's a great starting point and something for you to be aware of. So you can trade volatility specifically through things like earnings plays, where we know 2 weeks out, volatility starts to expand into an earnings release and then it contracts shortly thereafter. You can trade things like zero DTE options. I trade them pretty regularly. They're really tricky to figure out, to be clear. Most people think it's fast, easy money, and it's not. But there is a reasonable opportunity there if you kind of know what you're doing. But the point being is you can trade a lot of different forces that are specific to volatility. Next up, you can use volatility to assess market conditions. So you can look at something like implied volatility skew or the volatility surface, and you can see if markets are pricing in overall movement to the upside or the downside. Typically, we see what's called put skew, which is if you look at the same delta, call and put, typically the put will trade slightly more expensive than the call. That's because there's put skew. There's more implied volatility on the put side because the market generally fears the downside and they're trying to hedge the downside risk. So maybe we've recently had an example where NVIDIA coming into earnings, it actually had call skew where the markets were trading way more calls than puts and actually starting to trade it a little bit at a premium in certain expirations. So that's the market pricing in potentially a move to the upside. It's not perfectly accurate, but latest NVIDIA earnings kind of flush that out. Another couple things here. So you can have volatility as a secondary profit and loss factor. So what that means is, let's say that you want to buy calls because you're bullish. Well, if you buy calls when implied volatility is low, typically you have the wind at your back in terms of volatility because it means you bought cheap volatility. Now, again, volatility can stay low, but the propensity for volatility to drop even further tends to decline. So it means that you have the opportunity to make money if you get the directional move that you want, but also if volatility expands. And same thing for selling if you sell when it's expensive. Last thing here that's important to note is that sometimes volatility can be really difficult to wrap your arms around because implied volatility by itself doesn't always mean a whole lot to people. So here we could take a look at GE. The implied volatility here is 44%. And remember what I was telling you before about volatility can have a different relationship compared to historic volatility? Well, typically there's what's called a variance risk premium or a variance premium. And it's where the implied volatility tends to be overstated compared to historic volatility. And that's exactly what you see here. The other thing you'll notice is that kind of for these at the money options in GE, you'll see that the volatility for the slightly out of the money puts is actually a little bit lower than the calls. That gives you some context on where the market is pricing in potential movement or potential risk. Now, we need to ask ourselves, is this 44% implied volatility high or low? Well, if we compare it to something like Tesla volatility right now is 67%. So GE's volatility seems lower, right? However, if we take a look here, you'll notice that even though the implied volatility might be a little bit higher in Tesla, notice that the IV percentile is actually higher in GE. So what's IV percentile? Well, it gives us context about how volatile something is at a given point in time relative to itself, which is really, really important. So even though Tesla is more volatile than GE, right now on a relative basis, Tesla is experiencing lower volatility than it typically does. So in this case, the IV percentile on Tesla is only 35%. So that means that 89 out of the last 252 trading days were lower. And if you look at GE, implied volatility percentile is actually 59 with 148 days lower. So if you wanted to sell volatility, it actually looks like GE might have a little bit more of a volatility edge to it on a relative basis compared to Tesla. These are just a few ways you can use volatility in your trading. The world of volatility goes very, very deep. And it's one of my personal areas of interest. It's a fascinating way to look at markets. So if we should do more videos on this, let us know. Don't forget to like, subscribe, share, be an outlier. We'll see you guys later.